Hello. I'd like to welcome everybody to the Cooke Financial Group's In the Bullpen. Got our friend Jeff Kilburg with us here today. And Jeff is a dear friend, a Notre Dame grad, was the center on our football team. I have to love him extra for that. In addition, played for Lou Holtz, learned a lot, went to Chicago to the Chicago Board of Options and did amazing things there in a variety of the pits, and has just a great understanding of the markets. In addition to that, Jeff spent some time working with some of our favorite CNBC commentators like the Pete and John Najarian, a variety of others. I'll let him maybe express their views or what they're thinking these days. But we're lucky to have him here at the Cooke Financial Group today. Jeff, welcome to the Cooke Financial Group.
Chris, great to be here. I'm actually finally in the bullpen, folks.
In the bullpen.
I've been waiting for the invite, so thank you.
He's got the official background with us. We're ready to go. I thought we'd lead off today, Jeff, with a discussion. You were one of the few optimists back in about January of this year. I would say in my readings of the market, maybe 85% of the commentators were pessimists about 2023. And you were pretty optimistic from the get-go. Tell me why you started the year so optimistic.
Well, thanks, Chris. And you never want to take a victory lap because we're only about halftime right now. But it's fascinating to see in this post-midterm election year, for a lot of the people that read the CIO Corner that I published, we talked about the post-election year and what the markets mean. And historically speaking, going back to 1950, Chris, we have seen just a wave of certainty comes over, despite the fact maybe we don't have any certainty out of Washington by any means. But if you go back to 1950, the S&P 500 typical average is about 6.1%. That post-midterm election year jumps all the way up to over 15%. So
almost 10% better.
That's right. That's right. So I think that was one kind of leg of the table that I was standing on, but also it's the Fed's balance sheet. It was also that the majority of the velocity that the Fed injected into the marketplace, which transposed into every asset class, specifically equities, was already being digested. So I was cautiously optimistic. I like to lean on technicals. We talked about the S&P 500 where it was kind of tethered there around 4,000 for quite some time. So on January 1st, I did have a target, which I didn't change. I know some folks on CNBC tend to change or waffle or augment their targets, but 4,600 has been my S&P 500 target since January 1st. It was time stamped, and here we are about 45.50 almost, with the market up a little bit today. But I think bigger picture is understanding that we can get so much caught up in emotion sometimes, and sometimes you have to lean upon technicals. You have to understand the fundamentals and the fact that these companies that we talk about, we'll talk a little bit more about, but the pricing power in some of these companies, that's changed the narrative.
I do think it's really hard for a lot of people to understand how the movement of money moves the market. In other words, it's not just how's this company doing. It's also what money is chasing companies in general.
Right.
It's both. And the technicals, I think you do a good job of bringing that in.
Well, you bring up a great point, too. When you talk about money in motion, in 2022, there was a lot of repricing. There was a lot of profit taking. And there are a lot of people concerned maybe the year before, after the pandemic, in this market pulled back. And sure enough, we did see a little bit of a transition. But that was all led, and I go back to where I cut my teeth in Chicago, in the bond market. In the bond market, the leadership provided, if you think about the 10-year note, and I know this is a little wonky, but just bear with me for a second. The 10-year note started 2022 at 1.5%.
Yep.
It went up to almost 4.25%. That's a massive move inside of any decade, let alone a 1 year, 6 month timeline. So that velocity that the Fed intentionally injected to combat inflation then had to go somewhere. It's like throwing a big rock into the middle of a pond. There are ripple effects, and those ripple effects we unfortunately felt in 2022. And that's where I felt a lot of the carnage, the damage in 2022 was either overpriced or over-exaggerated once you kind of amplified everything in December with tax loss harvesting and how to try to reposition portfolios for 2023.
Room for 2023 to do better.
That's right.
Here we are. We're at the halfway point. You're right. And don't take the victory lap too early, but we're at the halfway point. We've seen a lot. We've got earnings this week.
Earnings season kickoff. Here we go.
Do we think the second half has promise, or do we think the second half has some caution and trepidation?
Well, I think where we are in earnings right now, this is the trough. We've seen expectations significantly be lower going into this earnings season for Q2. But what happened on Friday, and it's hard to take a snapshot for all of earnings season, but JP Morgan, Wells Fargo, and Citibank, they really talked about the environment. And I think it fortified the fact that the U.S. consumer is not only spending money, but they're borrowing money. And that's a fascinating piece because the consumer and small businesses and medium-sized businesses are borrowing money at these higher interest rates, which no economist talked about happening. So the fact that that's still transpiring, you look at JP Morgan, 67% year over year growth. That's amazing. They had a nice little nugget and they picked up in Silicon Valley Bank. That was a $3 billion kind of add on to their balance sheet. But even we talk about Wells Fargo, all these different components and complexities that go into these banks, which by and large, if you look at financials, remove regionals. But if you're talking about financials, kind of unchanged on the year in contrast to when you see technology up 40%. But I think this is kind of allowing some of the other market participants, not just the Magnificent Seven, to kind of participate.
You mentioned the Magnificent Seven. You and I know what that is, but many of the people on this webinar may not. Tell everybody how the Magnificent Seven is affecting the market, and then tell me if you think they can hang on and hold on, or if they're just massively overpriced.
When you talk about Facebook, Amazon, Netflix is not in the Magnificent, but NVIDIA is now in there. But you also talk about Google, and you also look at Tesla. So these Magnificent Seven, I think I got all seven there. It's the FANG stocks plus NVIDIA and Tesla. So Facebook, which is now Meta. When you talk about those names, it's actually interesting. And we talked a little bit of this here at Cooke Financial Group. There's actually a special rebalance going on in the NASDAQ 100. It's only happened twice, Chris, 1998 and 2011. So the NASDAQ 100 is feeling obligated, and they're allowed under their methodology to reduce the exposure. So those top five stocks
are almost too big for the NASDAQ.
Almost too big for the NASDAQ.
Trim it down.
So they're doing about a 20% haircut on those. And those five stocks, those top five stocks in the NASDAQ represent today about 47% of the NASDAQ. Their methodology allows them to go back down to 38.5%. So about a 20% haircut. But those same five stocks are 22.5% of the S&P 500. So there are further reaching implications. And since the NASDAQ 100 has come out with this special rebalance announcement, I think NVIDIA is up another 10%. But I think it is interesting in this moment in time because we already see earnings season. The last week of July, you can see the Apple, the Amazons, the Microsoft. These are all names that are really finding a way to navigate through the carnage and turmoil of 2022, but also embrace this artificial intelligence undercurrent, which is just all the rage.
It is all the rage. Boy, we've heard nothing but artificial intelligence for a while now. Do you think artificial intelligence, much like, say, the internet in the 90s, it's a great idea. It's going to be something significant, but is it going to be here as quickly as everybody thinks? Is it overpriced and ahead of itself today, or do you believe it has legs right now?
I still think it has legs, but yes, it has been spastic to see the way NVIDIA has really just over 200%. That doesn't seem sustainable. Yes, they're going to be powering the chips that goes into AI. Artificial intelligence needs more chips, more power to process some of these components. But at the end of the day, we're not being replaced. I think artificial intelligence, you go back to the Industrial Revolution, when you talk about disruption into the marketplace, disrupted a lot of blue collar workers. Right on the Ford assembly line, that got replaced at some point with robotics put in windshields and doors, and now all of a sudden you're seeing the writers and actors. They're worried about their jobs. They want to get paid more, and maybe AI starts writing some scripts. Now I don't think, and my friend Brian Sullivan, who's an anchor on CNBC, they did a great piece on his show Last Call where they made Brian Sullivan an AI, and they actually had him interview the AI person.
So the real Brian interviewed the artificial intelligence Brian.
And it was uncanny and it was remarkable. They had the inflection in his voice, and the mannerism was very similar, but each answer was a little bit vague. And a couple of questions where they succinctly asked him, what's your favorite movie? What's your favorite color? Of course, the AI wasn't able to, belt that off. But nonetheless, I think AI is going to be something that's important to our world. We may not even know AI is there. You're processing a mortgage or a boat loan or whatever you may be involved in. AI is going to be an undercurrent. So I think it's not going to be linear by any means. It's going to be up and down. But I think AI is here to stay. And we just have to make sure that the investments and the allocations that we have are proper, because when things do get out of whack, that's when you do see some of the wind come out of sail.
Well, and it's always been historically accurate to say that nobody ever got poor by taking some profits, and
100%.
A little rebalancing, a little diversifying has generally been useful after big run-ups. Maybe that'll happen in AI, and maybe that'll happen with the Magnificent Seven.
Yeah, and I think that's right. And I think earnings season is really going to depict that. And this week we get excited because we're going to see the rest of the banks. We're going to hear from Goldman. We're going to hear from Morgan Stanley. We're going to hear from Bank of America, but we're also going to hear from the Teslas and the Netflix and the Lockheed Martins. And, we have about 50, 60 companies in the S&P 500 reporting this week, and we're just getting earnings season going. So I'm a financial geek. I get all excited. This is like my Super Bowl. It happens 4 times a year, right? So we're going to get a better understanding. But what we have been able to take away from the 11% of the S&P 500 that has reported is that things are, let's rewind. Q1 earnings were better than feared. Now we're in an expected earnings chop, but things are okay. And the forward guidance, the confidence we see from the CEO is talking about pricing power. That's the tangible component of
improvement.
That's right.
Fantastic. When I think about portfolios and I think about this amazing thing called the American economy and American business, you've got a portfolio that your firm runs called the Essential 40. And it's the idea being that if we owned all the backbone components of America, we're going to do okay. Tell me about one or two unique components of the Essential 40 that maybe somebody doesn't think of, but it's essential to our way of life.
For sure. And, first and foremost, like a JP Morgan, you think about JP Morgan, how is that essential to my life? Well, most likely your mortgage loan, your car loan, any type of loan is tied to JP Morgan. So we believe, and if you think of the Essential 40, the whole premise of the model portfolio is that we want to find 40 companies that we believe that are essential and critical to the U.S. economy. Think of Peter Lynch in the 1980s. Peter Lynch was the buy what you know. This is buy what you know, but 2.0. It's buy what you use. And to go back to 1896 when the Dow Jones was created, the Dow Jones was created to be an accurate representation of the U.S. economy. That price-weighted Dow Jones now is not really accurate. It can be top-heavy when it's price-weighted. So we have an equal-weighted portfolio, which, as you know, was great in 2022 because the portfolio lost about half the S&P 500. We still own Microsoft, Facebook, Google, Amazon. However, we also own names like International Paper.
Yeah,
that doesn't seem sexy. Lockheed Martin, not very sexy.
Supposedly, we're going to go to a paperless society.
Well, we will see. But you talk about 3M, you talk about Masco, Home Depot. These are kind of names that you don't hear a lot on CNBC because we want to talk about the Magnificent Seven. But nonetheless, these are companies that we deem to be critical.
So I notice on the screen as I'm looking up that we have one question on AT&T. Talk about what at one time was an essential piece of the American economy, but today it's kind of a bit piece of the economy. How's AT&T fit in, or do you have any thoughts on that?
No, I do. And, quickly, I'm thinking of leaving AT&T from a cell phone service perspective. But stock aside, the stock has been tough to own for quite some time. And, I think there's been a couple of missteps on, intermanagement there. And, they're not an essential name, so they don't qualify. Yeah. That's kind of the overarching criteria. But if you own the name at a lower price, you have to be considerate of what your cost basis is. There's an opportunity where you're not going to pay Uncle Sam a lot, and then there's an opportunity to maybe put allocations somewhere else.
Got it. I think back on when AT&T was the dominant force in communications.
Yeah. And
I think today of like an Apple, which is a dominant force in smartphones, which in essence is much more than communication, but communication. AT&T had its day when it suffered and became something different. I think of a General Electric, which was the largest and the biggest and the baddest, and it suffered and became something different. Do we think Apple has the staying power to become much more than today's Apple, or is Apple potentially going to suffer and have some competition from unknown quarters?
It's a great question. And Apple now over $3 trillion. Is it going to go to $6 trillion in the next year? Most likely not. However, what they've done going from a growth company to more of a true service company where, I don't know about my kids, we're locked into the Apple ecosystem. We are too. I can't get out. And all of a sudden, every month I'm paying more for storage and more services. And all of a sudden it all kind of ties in a bundle. So I think it's going to be really interesting to see how they continue to grow. But the way they're producing cash inside of Apple, it's like a utility, yes, right? So it's really become a core holding now. A lot of people are overweight Apple, and that hurt portfolios in 2022. But to see the way it's come back in 2023, it's very different than an NVIDIA or a higher beta stock.
Do you worry at all that Apple's priced like a growth company, even though in some fashion in the back room, maybe it's become more of a value company?
I do. And I think that's, I think part of that was 2022, that repricing. But I think right now there's more room to run on Apple just because it's such a sticky, tangible business, which is different than so many other technology companies where, if you have the right product at the right moment, you're in. If you don't, and Intel's an example. Intel's finally finding their step, but they made a couple of missteps where that's very different than Apple. So I think Apple will continue to deliver. I would be curious to see what they're going to do with all their cash. We've been talking about what they're going to do with their cash for year after year. but is there some type of big purchase coming down the pipeline that's just going to make them even bigger? So I would definitely hold that position, but be considered and nimble. Whenever you get so excited about the AI and all of a sudden it starts spilling into other, you have to be a little bit leery. The trader in me definitely throws up a question.
Walk away when it's too optimistic.
Not to be a contrarian, but yes, it's good to be vigilant.
So I want to throw out to the crowd that might be on the other end of the webinar here. If you have questions, please type them into the chat or type them into the Q&A box, and we'll be happy to try and answer them. There we get one right in. What are our thoughts on timing the markets versus time in the markets? Fantastic question, especially today. I think the uncertainty of a recession has been hanging over our heads for probably 6 months. And it may well hang over our heads for another 6 months.
Right.
Will it be a recession? Won't it be a recession? When will it start? How bad will it
Goldman
be?
just downgraded their recessionary expectation by another 5%. They were at 35%. Now they're at 20%. But it's a great question about market timing or timing the markets. And, my friends at White Charts actually put together a great slide to kind of really better understand if you're trying to time markets and you're taking cash out in the great financial crisis. You can see what your money looked like on the sideline for a year and what you missed. And even in COVID, there's another slide that we can show, your clients. Even in COVID, if you decided to go on the sideline for a month, what did that do? Or what happens if you've been out of cash? And it can be traumatic. It can be really traumatic.
Truth is that if you go to the sidelines during these traumatic times or difficult times, it's generally hurt you.
Right. And even if you look at, the last 25 years, on average, there's 10 great days of every year. And if you miss those 10 days, your return is wildly affected and impacted. So I think if you have the ability, if you have the crystal ball, please send it over here to KKM Financial. We'd love to have it. But nonetheless, trying to time markets is a dangerous game. And I think that's proven out with some of the charts we've seen.
And I might just tag on to that question with, don't try to time currencies. Don't try to time bond yields. Don't try to time the market. If in any of these cases you're wrong, the recovery can be really, really painful from that. Most of the time in all these asset classes, if you own them for a long time, you do fine.
Well, that's the power of longer-term ownership. And I think you have to be considerate of all those nuances, because what happens is someone times the market once, they feel they can do it every time. And the odds are against you. It's kind of like Vegas.
I'm a big believer, and this is true of Vegas, and it's true of timing the markets. I pray, and this is going to sound odd, I pray that people who go to Vegas or people who time the markets lose on their first hand. Because, it's so dangerous if you win once or you win twice and you think you know something, and then you commit way too much and you lose, and because you thought you knew something, and the reality was we didn't really know anything special. It's timing is so difficult.
It is. Even for the professionals.
Yeah.
I consider myself a professional money manager, and to try and time things, it's difficult. It's challenging.
One last question, which is more for fun than it is about markets. Gosh, you've had this privilege, I think, of being a CNBC commentator and being on the TV with all these fun people. What are a couple of moments when you just think, what a hilarious day or what a fun day, and who are the really fun people that maybe something happens off camera that we wouldn't know about, but it makes you think these are great people, or maybe these are horrible people and we shouldn't watch them. I don't know.
No, there's some great people at CNBC. I'm very fortunate to be in the CNBC family for 15 years as CNBC Contributor, and we've had some great moments. And I remember Brian Sullivan was hosting halftime report for Scott Wapner, and it was John Najarian, Pete Najarian, myself, and Brian, who's not a small human. So 4 big guys. And in all seriousness, he asked for a couple of the stage managers to come out, and he said with a straight face, he's like, "Do you think we can secure the set here a little bit more? We have a lot of beef on the set." And the whole place was up for grabs. And then 5 seconds later, we were on air all laughing. Luckily, the market was up that day. But I've been fortunate to meet a lot of great people there.
Jeff's down a few pounds, and he's still a solid 250 here. 6 foot what?
6'5".
6'5", 250. This is a big boy, former center of Notre Dame's football team. But what were you at playing weight?
305. And
305.
COVID. I think we all found a little love in COVID, so we're still trying to get back down under that 250 mark. My wife reminds me often.
Well, I don't know if being bigger makes you a better money manager or not, but I hope we all have big brains anyway, and we try to put them to the best use. I want to tell you that I appreciate all the time and all the thinking that you put into investments on behalf of us and our Cooke Financial Group clients. I guess if I turn this one other way and say, skip the market for a second, well, let's talk about the market for advice. You've also been able to view over the years the Merrill Lynch's and the Morgan Stanley's of the world versus some of the little tiny independents like the Cooke Financial Group. Tell me how you think the world's shifting between kind of these large firms and some of the independent firms, and is there opportunity or risk or what happens?
It's a great question, and I've been fortunate enough to work with great independent firms like yourself. And where I favor and where I think the whole market is shifting is that clients want to have conversations. Clients do not want to be read a response off of a pre-printed list or be put into a bucket. Here at Cooke Financial Group, you guys are creating custom bespoke solutions that really serve needs of your clients. And I don't think, this is not a knock on the big wirehouses, but I think sometimes you get brought in by the great money manager, then you get kicked to an assistant, and you get thrown into a cookie cutter situation. Yeah. And if a need comes up, either emergent need or some type of planning need, that succinct detail, that bespoke component is just not there. So I've been fortunate enough as an SEC registered firm for over a decade in the money management business. I'm aging myself now, but you can see with the gray hair, over 25 years. I prefer to work with independent groups like the Cooke Financial Group, where I can be one tool in your toolbox, because you have the ability in an open architecture, unbiased manner to find the solution that best fits your client. You're not forced to stuff whatever product is that, I'm not naming wirehouses. See what I did there, compliance? I'm not naming wirehouses, but whatever that product that's being stuffed is not here. So I salute you, and I support a lot of the independent groups.
When we left the wirehouse, one of our reasons was we were being pushed into certain kinds of formulas or standardized products, and we didn't always think that was wise. So that was.
Well, I bet your clients appreciate that too, because it makes a difference. It does.
Question just came in. Thoughts on the emerging markets versus the USA? And I think that's a great question. The emerging markets are exciting, different, probably part of the future. But the good old USA has been leading for a long time too. So
it has, and it's a great question, because it's a really interesting moment in time. We're seeing the U.S. dollar at the 1-year low right now. So that dollar coming down is obviously correlated to inflationary expectations. Inflation's cooling. Fed most likely is done. So that's put a really boost in the emerging markets as well as international markets. So I think there's more room to run there, but it will be interesting to see, because the Federal Reserve has been out in front. Every other central banker across the globe has been following the central banks. So this has put a small boost in emerging markets. I think there is opportunity there, but I think you have to be considered, but also risk suitability. You have to understand, it's volatile. So are you able to stomach a 5% allocation, or can you go all the way up to a 10% allocation? That's going to be different for each investor. So that's where it really makes a difference.
I do think that makes a difference. Some of my clients have heard me say there is approximately 1 billion with a B, 1 billion people entering the worldwide workforce over the next 10 years. And 99% of that billion is in the emerging markets.
That's right.
We've never seen that numeric size hit the workforce. And inevitably, jobs and productivity move toward those workers. So there probably will be, over the next 5, 10, 15 years, a movement of GDP toward the emerging world. The question is that movement of GDP investable?
Right. And is it linear? Because we're seeing right now a lot of graduates over in India right now are having a hard time getting jobs. They're living at home with their parents. So you see some of these reoccurring themes that, happened a couple of decades here domestically. But I think overall, you're seeing international markets come back to life. If you look at international markets compared to the S&P 500, they've dragged. They've been laggards. But I think there are opportunities where you can tilt slightly to try and capture that movement and that job work.
And what about China, which is obviously a huge emerging market?
Well, China has been fascinating because, being in Chicago, we kind of had China-like lockdowns. So that was interesting to see. But we would have thought that China was going to be coming back online, the economy truly reopening. It hasn't. It's been starts and fits. They've gone on lockdowns. They've dealt with COVID differently over there. And now all of a sudden they're having a Chinese investment day where literally they're having a show and tell, inviting companies to come in because of the lack of investment. So I'm optimistic.
In other words, their lockdowns have hurt them so badly that they're begging for new money to come.
Correct. And I think the uncertainty of investment in that country has dramatically changed since COVID because of the supply chain issues. And when factories aren't open and people have demands on products here and they can't get the input to the products, that adds up into not making money and going bankrupt. So I think China coming back online would be great for the global economy. I know we've had some geopolitical tensions ratchet up. I think that should simmer. We should find a way to work together. But right now, I think when we do see China come back on, that's going to be positive. It's a positive. It is.
Next question that came in from our audience is there a certain sector or sectors that you think will do well for the remainder of 2023? It's a little like market timing, but we pay you for this. So come on.
Well, no one's throwing tomatoes, hopefully, but it's interesting. In December last year, when I was talking about owning technology and rebalancing, that was not a welcome or embraced thesis, but sector from a technology perspective is up 40% year to date. I hopped on CNBC with Brian Sullivan and Frank Holland. I talked about the nasty of the NASDAQ. Nasty of the NASDAQ is a similar portfolio to like the dogs of the Dow, the worst performing NASDAQ stocks, which were NVIDIA, Tesla, AMD, and Lucid. Those stocks have really come back.
Last year they suffered. This year they're great.
That's right. So I think it's interesting. I think sector perspective, technology has more room to run. There will be some reset repricing potentially around the special rebalance of the NASDAQ 100, but the theme and the interest rates associated with technology. We saw the 10-year just last week above 4%. Now we have a cooler, better expected CPI data. It's back down to 3.8, 3.75. So I think technology is going to move, but industrials, is something that a lot of people have kind of neglected, not as sexy as typical. And then lastly, financials.
Yeah, we got to make stuff. Industrials is important.
That's right. And I think the last piece would be financials. Financials are unchanged on the year. They really had a hard time digesting, the move in rates. I'm not talking regional banks. I'm talking financials. You talk about Visa, 52-week high, some of the other stocks that feed into the financial theme. I think that's where you want to be.
Good answers. I appreciate it. I'm not seeing any other questions at this moment. We're at about 2:30. I try and keep these bullpen sessions to about a half an hour to be respectful of everyone's time. If there are other questions, please email them anytime to the Cooke Financial Group, and either we'll answer them ourselves or we'll get them in the hands of an expert like Jeff Kilburg here. And Jeff, we're grateful to you for coming in to visit us today, and grateful for a couple of good stories about CNBC and Notre Dame football.
Go Irish, and thanks for having me, Chris. Pleasure being in the bullpen.
Are the Irish going to be any good this year?
Undefeated. That's what I say every July.
That's from two domers. I don't know what everybody else thinks. Have a great day.